Okay, so in Chapter 8, we're going to be talking about the purchase side of inventory, whereas in Chapter 7, we were dealing with how to sell inventory. In Chapter 8, we're going to cover all the concepts in terms of how to buy the inventory and also actually how to pay for this. So we're going to talk about some terms in here about what's called purchases, something called cost of goods sold, and so forth. But again, this is related to Chapter 7, but this is going to be the other side because remember, a merchandiser does two things. They either buy merchandise or they sell merchandise. So this is the chapter that we're going to be dealing with basically is the buying part of the merchandise inventory. So as you read through this, typically, most companies have a department that typically focuses on just the purchasing of the inventory, and they come up with all the arrangements, all the negotiating right here, the negotiating terms of how you're going to pay for it. Typically, I was at a couple large companies. We had a department, this is all they did was work with vendors and suppliers in terms of buying the inventory. So as you can see in terms of procedures, typically, we have the sales department. Again, that's from Chapter 7, that, they're going to send some sort of authorized requisition to the purchasing department. So they're going to start it. And then once it's going to get to the purchasing department, obviously there has to be some sort of authorization. It's called a purchase order that then they're going to then contact the supplier. And then of course there's going to be some sort of receiving report is going to be prepared once you do receive the merchandise, because typically whatever you order should be matched with what you receive. So this is where you can kind of detect if there is any errors in the shipment, if they shipped the wrong goods. And then finally, the accounting department is the last step. They're going to get the invoice and copies of the purchase and order and so forth. So a lot of this is we're not going to get into in this class, but you have to have some sort of separation of duties, because if you don't, if you have one person doing sales and the purchasing and so forth, you're basically going to open yourself up to fraud and theft. So typically you're going to have some sort of segregation of duties for each one of these departments so that you can have some sort of integrity and verification in the whole process. And here's an example of what a purchase invoice might look like, and you can just kind of look at some of the details. Notice there's a date, you've got an order number, who's it being shipped by, you've got the payment terms, which we'll get into a little bit later. This is N30. Notice you've got something called FOB Dallas. We'll talk about what that means a little bit later on. Down here has all the cost details. It's got the freight. This was an order of some men's suits and so forth. But basically, this is what the purchase order is going to look like. And so once you get this, you can then match it to the receiving report to make sure that what you ordered is what you had actually received. So in other words, if they're ordering 10 suits, if that's in the order, once you get the order, you're going to inspect it and make sure that there's actually 10 suits so that you know that you got the right shipment. Now, in terms of this particular chapter, here's going to be some of the new accounts we're going to be getting into. We're going to have what's called a purchase account, a purchases returns and allowances account, a purchase discounts. There's going to be a freight account or transportation account. The purchases account is going to be used to record the merchandise inventory. Whenever we buy that, we're going to be debiting that account. The purchase returns is whenever we basically return something that was shipped wrong or there was a mistake in it. It's going to be a return. We're going to have the purchase discount, which is basically when we pay early, we get a discount on the price. I'll show you how that works. And then, of course, freight in is going to be the account we use to account for the shipping part of shipping the merchandise. So again, like I just said, the purchases account, that's going to be used to account for the cost of the actual merchandise. And so sometimes we refer to that merchandise as simply just inventory. And again, the freight in account, this is basically for the shipping cost. Okay, so we're going to put that all into this account called freight in. Sometimes it's called transportation in, but it's pretty simple. It's just basically the freight company billing you for shipping the goods. So regarding a couple shipping terms, one's called FOB shipping point and the other one's called FOB destination. It talks about handling the payment, but I'd also like to add in here who's got the title to the goods while they're in shipment. And if it's FOB shipping point, the buyer has title to the goods once they're loaded on the truck. So you could be in St. Louis and the goods could be shipped from California. Once those goods are put on the vessel, it doesn't matter where they're at, the buyer has legal title to those goods, and that's going to matter because that means that it would go on the balance sheet right at that point. FOB destination, the buyer only has title to those goods when they are actually received. Okay, so if you're in St. Louis, you don't really own the goods until they actually come to St. Louis, so you have to actually physically receive those goods. The rest of it's pretty straightforward. It talks about, who basically pays. I'll just kind of add that whether the seller pays the freight up front or the buyer pays the freight later on, ultimately, if you're buying merchandise at some point in time, that shipping cost is going to be passed on to you at some point in time. So here you go, you get to this term called the cost of the goods sold, and that's really your inventory. But notice, if you have purchases, which this is going to be the cost of your inventory, you actually add in the freight. The freight is actually considered part of the cost of the inventory. So if, let's say you had total purchases of $4,760 and total freight of $360, your actual total cost of inventory is $5,120. And what's going to happen is when you sell this inventory at whatever price, when you sell it, this inventory is going to be called something called cost of goods sold, which is basically, that is an expense account. It's basically expensing your inventory, but cost of goods sold in this case, if you sold all this inventory, this would be the cost of your inventory sold. It's called cost of goods sold. Okay, and so the basic journal entry to record your purchases is pretty simple. Notice you debit the purchases account right there. In this case, it was $4,760. Notice the freight in gets a separate line item. In this case, it was $360. And then, of course, they just credited accounts payable for $5,120. So notice the purchases is a separate account from the freight. And even though all this is considered inventory, you still keep it separate. It helps you keep track of what's the purchases of just the inventory versus also what is the shipping cost. And of course, this entry is showing you basically you're making the payment. And so basically, just like we've done in previous chapters, you're going to debit accounts payable and you're going to credit cash for the amount that you're going to pay on the invoice. Now, obviously, you could also have purchaser returns or purchases allowances, depending on if you have the wrong goods shipped. The goods could have been damaged. You might actually keep the goods and try to resell them anyway, and the seller might give you a reduction in the price. That's going to be called an allowance. And notice typically these type of accounts, the purchases, returns, and allowances are going to have a credit balance. So whenever we do record those are going to be recorded on the credit side of that account. So notice in this particular example, we had some purchases of merchandise. That's going to go to $4,760 to the purchases account. The freight charges is $360, and then you're going to credit accounts payable for $5,120. So then let's assume that some of the goods were damaged, and in this case, we're going to keep them and try to resell them anyway. So the supplier grants us an allowance of $476. So look at the entry. You debit accounts payable because that's going to reduce the amount that you owe them. And then you simply credit the purchases, returns, and allowances for $476. It essentially reduces your cost of inventory. And then notice now that once you do end up paying for your goods, you debit accounts payable, you credit cash, but notice the amount that's going to be down from that $476 that you'd already returned. Now, the other issue to deal with is sometimes we have what's called a purchase discount. And you might see something that would say, if I go down here, that this 210 in 30, which basically means if you pay your bill within 10 days, you get 2% off the price. Sometimes you might see a 110 or a 310. It all means the same thing. The first 10 days you've got to pay the thing. If you pay it early, you're going to get a discount. And I'll show you in a moment how that works journal entry wise. So notice in this particular example, we have merchandise that had cost $3,000. Notice that goes right to the purchases account. The freight in this case was the freight was $200. So that's going to go to the freight in account. And so then the total cost here is $3,200. Now, keep in mind the terms of this buy is a 210 and 30. So look at the date. They bought this thing on January 10th. So if they pay by January 20th, they can actually take 2% off the invoice price. Now remember, does not include freight. The freight is kept separate because typically that's going to be charged by a shipping company. So these discount terms are going to be based on only the merchandise, only that $3,000. So the discount is not taken on the freight, it's only going to be taken on the merchandise. So notice, let's assume if you look at the actual date, notice they're going to pay it on January 19th. So $3,000 was the cost of the merchandise. So if you take the $3,000 and you multiply that by 2%, you get a $60 discount. So notice that gets put into this account called credit purchase discounts. You still debit AP for the $3,200, and whatever's left over, in this case it was $3,140, is basically your cash payment on the invoice. But remember, the discount is only taken on the merchandise. The discount is not taken on the freight. Now, the next item is sometimes you're asked to calculate what's your total cost of purchases. And the basic total cost is the idea is right down here, which is basically your invoice cost. You got to add in your shipping. You're going to subtract out your purchase returns and also subtract out the discount. So basically, let me go back. So you're going to add your invoice prices. You're going to add the shipping. You're going to subtract the allowances, and you're going to subtract the discounts. Once you net all those, that's going to be what they call your net cost of inventory. And so notice they've got the basic calculations right here. So notice you've got purchases, you add the freight, and then notice you subtract out the allowances and the discounts, and this number right down there would be your total net cost. Now, in the next section, we're going to show you a little bit about the cash payment part of buying for or paying for your merchandise inventory. So typically, you may come across something called trade discounts, and usually what happens is there'll be some sort of trade magazine or so forth that you don't want to have to reprint every single month, and that can get kind of costly. So sometimes you might be offered what they call a series of trade discounts. So the way that works is, in this case, let's just go through this example. There's merchandise, there's a sale with a list price is $1,000. There's trade discounts of 20% and 10. Terms are 2, 10, and 30. The sporting goods purchases merchandise with a list price. So the list price, that's the number that basically we're going to start with. That's always your starting point. So if you go down here to the $1,000, notice you take the first number. The first trade discount was mentioned at 20%. You take 20% of 1,000, that's 200. You subtract that from 1,000, you get $800. Now, the next discount, then when it said 10%, you then take 10% of that number. So the 10% of 800 gives you $80, and then you subtract that from 800 and you get your net price of $720. So typically, anytime you get these trade discount type of situations, you take the first percent they give you. In this case, it was 20%. You multiply by the list price, you subtract that, you get a net price right there, net cost. And then you take the next percent and multiply that by the second one, and then you subtract that. So $720 is really going to be the price you're paying, not the $1,000. But that's how you do what's a calculation, what they call a series of trade discounts. Now, if sometimes I see 3 or 4 of these percents, if they had said 20% and then 10%, and let's say the next one was 5%. If they had done that, then you'd go down here and you'd take 5% of 720 and then subtract that as well. So basically, that's how the trade discounts work. You just have to keep multiplying the percentages and keep deducting to get down to the net price. And so notice, look at the actual entry. You would debit purchases for the 720. You credit accounts payable for 720. And then notice also, this happens on January 20th, and there's a 210 and 30 on this. So if they pay by January 30th, which they do, they're going to also get a discount on this as well. So notice down here below, they pay on the 29th. You're going to debit accounts payable for 720. How do you think they get this discount? That discount is basically your 720. Multiply that by 0.02. There's your discount, called your purchase discounts, and then you credit cash for the difference. Now, to help you keep track of who you owe money to, typically you have what's called an accounts payable ledger. This basically just lists all creditors basically on account that you owe. And this just basically allows you to keep track individually so that you can make all your payments and you don't miss a payment. And note, typically, you're going to have in the general ledger. I'm just going to kind of give you the illustration right down here. In your general ledger, you would have an accounts payable, what they call a control account. Okay, I want you to think of that as really, that's like the summary. And then in your AP ledger, basically it is what it is. It's just a ledger of creditors. Every one of your customers, we'll just say customers A, B, and C, and let's say we owed each of them $100 each. So if your AP ledger had 3 customers that we owed $100, your control account in your general ledger would say $300 because that would be the summary of your AP ledger. So your AP ledger, I want you to think of that as basically that's going to be the detail list, and then the control account in the ledger basically is going to be summarizing everything from the AP ledger. So they should always balance. And of course, you may come across something called prepare a schedule of accounts payable. All that is doing is that's just listing all of your creditors from your AP ledger.